Hello, I'm Kim Parley, and thank you so much for joining us. As you just heard, there was two big pieces of news in oil this week. The first being that the world's biggest oil producers were not able to strike a deal to freeze production, an outcome that some were hoping for in order to boost oil prices. The other involved news from workers in Kuwait calling off a strike. Oil prices initially tumbled on the news, but have shown such resilience since then because of some inventory numbers that came out today. So which way is the bouncing ball going? What is next for oil? Bart Mellick, head of commodity strategy at TD Securities, joins us to explain what the heck is going on. So I just want to start with my first question is, what the heck is going on? I feel as though, and I've been following, these markets not as deeply as others like yourself for a long time, but I just find it confusing what the market is actually putting weight on and what it isn't putting weight on right now. So just from big picture, what do you think is happening with oil right now?
Well, I think it can be summarized fairly easily. It still doesn't make a lot of sense.
Okay.
But I think a lot of speculative investors want oil go up, and they have responded to headlines recently, most recently, particularly today, that drove it that way. In particular, references from Nigeria that a possible meeting may happen in May was apparent catalyst for moving oil higher, past some technical resistance. Really didn't have a basis in reality that this is possible or even remotely likely, but it seems algorithmic traders have responded to those headlines.
On the algorithmic traders themselves too, I mean, how much of that is really torquing the market, if you will? I mean, we hit, people talk about technical levels and, some people kind of look at technicals and don't really believe it, but algorithms are often built on technical levels, so they really do matter, do they not?
I think absolutely, and a lot of options traders will write their strikes based on technical levels.
Yeah.
So there's a lot of truth in saying that markets tend to want to go to a particular level for no other reason is other than that, because that's the level that has been written into their behavior structure.
Right.
And we've seen that time and time again. Doesn't necessarily mean these levels stay there for any length of time, but as we've witnessed today, markets wanted to move, and they did.
Okay, so 44 or 43 and change is where we were with West Texas Intermediate today in oil. Where do we go from here? I mean, what do you see are the catalysts moving forward, and I guess maybe from supply standpoint and demand standpoint?
Well, in the relative near term, I think we bounce off these highs into the sort of the lower end of the trading range, maybe the mushy middle, at least another few dollars lower. When we look into the rest of Q2, we're still looking at 1.2 million barrels of surplus coming up, and there is very little anyone can do about it, and that would include any agreement to freeze production at January levels or anything like that. We are seeing pretty robust declines in shale production and other non-conventional production later in the year. That trend has already started, but it's not going to prevent a surplus from building. So at this point, it's still premature to say that the market is reaching balance. We think it ultimately will, but that's not going to be for a quarter or two.
Why is it then, and I asked the naive question, that the surplus is still building essentially because we haven't seen that decline in production happening as quickly as we want, and yet the market seems almost immune to the bad news, and it seems to start trading off these little things about inventory declines in distillates today. We saw that kind of pop up price. Like, why, when the meta picture hasn't changed, why are we seeing that strength from where it was in the 30s?
I think people are looking for the targets in the long term, and we have long speculators wanting to get in. The contango has flattened out somewhat, so it's less expensive to roll those contracts. And part of the reason today we've had the roll as well, and the most active contract wasn't the one that we were looking at.
Right.
Then as things rolled, that almost automatically helped things out as well. So I think traders are looking beyond the immediate. But they are, I think, at this point, pricing for perfection. And my experience has been it's never perfect. And there is always a bumpy road ahead. Even though we do look, when we look at oil, we see $60. I think it's still going to be a bumpy road.
So $60 would be the equilibrium price. So when you think things are more in balance?
Yes, I think so. You know, we think by year end we're going to hit $60. At that time, we more or less see a balanced market and a good probability that we're going to go into deficit. But as I said, in the second quarter, that's still a big uncertainty.
Yeah, we're swinging. The pendulum is going back and forth right now. So
that's right. We're you know, there are a lot of risks out there. There's no guarantee that the current downward price production trajectory will continue at an accelerated rate, as some people think. There's no guarantee that OPEC won't choose to hike production, Saudi Arabia in particular. There are a lot of uncertainties still away, you know, until June. There's the possibility of Brexit destabilizing demand prospects. So a lot of risks out there.
And how would, you know, just to kind of really pull these things out, why would Brexit disrupt demand? Or like, why would that impact the oil market from a trading perspective? Just for someone who's listening going, what does that have to do with oil?
Well, it could create a lot of systemic uncertainty.
Okay.
And you could have a situation where volatility goes sky high.
Yeah.
There is uncertainty of what happens to some parts of the world, in this case, Europe. And you could get a situation where risk appetite dries up, availability of credit is unavailable, and then people conclude that because of that, future growth may be impacted very negatively. And then if you look at oil, you go, well, if growth isn't going to be there, demand isn't going to be there, and therefore the expected balance will not materialize.
Got it. Okay, so 60 is where you're thinking if it's in balance, fasten your seatbelt. It may get there, but there's a whole lot of bumps along the way that could happen. And it may not get there for all those reasons you just said.
Absolutely. Our view is 60, but we're quite certain it's going to be pretty bumpy.
Okay, let me, and thank you for connecting the dots. That's always, I'm looking for to do that. Let's talk a bit about the metals right now, because we've seen some positive price action with some of the metals as well. Let's go through for zinc. And you like zinc right now. We
like zinc. Zinc is a very good metal to buy when you expect China to pick up. And we're seeing evidence that China is maybe not batting it out of the park, but it's stabilizing, and that's important. So we're no longer talking about 3% growth in China. We're saying around 6-ish, 6.5, somewhere around there, which signifies a pretty decent demand.
And zinc is used for, again?
To galvanize steel to rust protected.
Right.
You would galvanize panels in cars, trusses for buildings.
Right, so building structures, anything that's you're building, you need zinc. Silver, how has it performed versus gold? Because gold's had a very nice a little pickup in the past little while.
Well, silver has actually underperformed relative to what you would expect. Silver is roughly double as volatile as gold, so you would expect if gold goes up 1%, silver should do twice as well. It really didn't do that for much of the time that gold was rallying, and now it's playing a bit of catch up, and that's also true for platinum, which we like as well.
And why do you think that was? I mean, why do you think the relationship was disconnected? Do you as in your world, do you care, or do you just notice that it hasn't, and then you figure out how to play with it?
We care. We care probably a little bit too much.
Yeah.
Part of the reason was silver is not only a precious metal in the same way as gold is. It's very much a monetary unit from some people's perspective, but it is also very much an industrial metal, where 60% of it is industrial demand. And a while back, we were quite worried about China. We were worried about demand there. We were worried about consumption in the electronic industry, in the chemical industry, and all industries that are all demand that's associated with industrial activity and exports. Well, now we're looking at China and things have stabilized. So we're getting a positive sentiment from gold, and the industrial side is looking better. And I think very importantly, the US dollar upward momentum has reversed. And I think that's been a big catalyst for silver as well.
I've only got 5 seconds here, but I do want to ask you gold. Do you think that party has played out on the yellow metal?
We think most of the party has played out. There's probably some upside still.
Yeah.
But we've been having a heck of a time breaking out into the 1300 zone. We just haven't done it. Big reason is that longs are overextended. It looks like there's a lot of longs out there. They're overpositioned, and it seems there's little appetite to take it that extra step that would propel it into the 1300s for now.
All right, Bart, thank you so much. Encyclopedic knowledge as always. Pleasure to have you here.
Thank you very much.
Bart Mellick, Head of Commodity Strategy at TD Securities, joining me here in studio.